Hi everyone, I'm Paul and welcome to today's video, which is an introduction to ICT's fair value gap method. Since I started following ICT's 2022 YouTube Mentorship Program, I've been getting lots of questions about fair value gaps. So I thought I'd put together a video to help people with some of the core concepts and answer some of the most commonly asked questions. Hopefully this helps people to get a really good foundational understanding of fair value gaps so they can start incorporating them into their trading. But before we go any further, make sure you hit that like button and subscribe. And if you like the fair value gap method, make sure you check out my reviews of ICT's 2022 YouTube Mentorship Program. And of course, make sure you go right to the source and check out ICT's channel. I've put a link for it in the description of this video. So now that you've helped me out, I'm going to help you out. So let's jump into today's video. So today's video is an introduction to ICT's fair value gap. And we'll just run through a brief outline of what we're going to cover in today's video. So our first section will be on what is a fair value gap, followed by how would you use a fair value gap, and then how to use the fair value gap. We'll cover some of the frequently asked questions and then run through just really quickly some real world examples of fair value gaps across different time frames in different asset classes on some real charts. So first of all, what is a fair value gap? So the fair value gap is the creation of ICT, or the inner circle trader. And as I mentioned in the earlier part of the video, there's a link in the description to ICT's channel. Now I really recommend you check that out, definitely subscribe. There's an enormous amount of information that's all completely for free, and regardless of whether you're a new trader or an advanced trader, there's going to be something in there for you. You might find some of the ideas that Michael talks about in his channel as a little bit controversial or very, anti-establishment in terms of what you've heard in the past, but go into it with an open mind. And as you'll see with the fair value gap, a lot of the things that he talks about and teaches on his channel, you'll find all the time, and it will help to either reframe the way you look at the market or completely change the way you approach your trading, as it kind of has with mine. So a fair value gap is a 3-candle pattern. As I mentioned before, you can find it across all different time frames and across all different asset classes. Now, fair value gaps can either be bullish or bearish, and they just have different formations when they're either bullish or bearish. And so the core concept behind a fair value gap is it's an area where price has been inefficiently delivered, and as a result, there's a gap or an imbalance that's present on the chart that we're looking at. And the reason why this is important is because at some point the market or price will come back to that area, and it'll either trade up into that area or price will completely rebalance that imbalance at some point in the future. And so the fact that we can predict that as traders, we can use that to our advantage, and we'll go through that in one of the later slides. So next, what is actually a fair value gap? And so as I mentioned before, we have both bullish and bearish fair value gaps. And so we'll start with what a bullish fair value gap would look like. So fair value gap, as I mentioned, will have a 3-candle formation. So 1, 2, 3 candles. And the fair value gap on a bullish formation is formed between the high of the first candle and the low of the third candle. And so a fair value gap crosses the body of that second candle. Now the second candle is quite important. We want this to be quite pronounced. We want it to be a powerful move in the direction that we're looking for. So in the example of a bullish fair value gap, that second candle needs to be a powerful up close candle. Now, when I say powerful, it should really stand out on the chart. It shouldn't be a weak candle. It should be quite pronounced. And with the first and the third candles, they don't really matter so much in terms of the wicks. The important thing is that there's a gap created, and that's between the high of that first candle and the low of the third candle. As you'd expect, your bearish fair value gap is just the opposite of the bullish fair value gap. So we're looking again at our 3-candle formation, 1, 2, 3, and that second candle is a powerful down close candle. But again, the opposite to our bullish fair value gap, our fair value gap in this example is formed between the low of the first candle and the high of the third candle. And our fair value gap again crosses the body of that second candle. And so why would you actually use a fair value gap? Well, there's 2 basic reasons why you'd use a fair value gap. And the first is that we can use fair value gaps to identify an area or a zone of interest for a future trade that we want to place. So it allows us to project forward where we think price might go, and we can look to enter a trade in that particular area at a future date. Because remember, we expect price to go back up into that fair value gap to balance out that efficiency, and it's either going to touch that area or it may completely rebalance that imbalance at a future date. We can also use, and this is the second reason why you would use a fair value gap, is you can use a fair value gap as a method of entry unto itself. So because of the way a fair value gap forms, it allows us to define very clearly where our stop will be and where our limit order would be placed, which allows us then as traders to be able to calculate and define our risk, which is really important. So that's one of the reasons why I really like fair value gaps as an entry as well, is because it tells me where I should get in and where my risk is or where I'm wrong. And the other great thing about fair value gaps, and this is probably a little bit more advanced, is that you can use both this first and second point together. So what you can do is use a fair value gap to project into the future a zone of interest, and then in that zone of interest use a fair value gap again to enter in that particular area. But that's a more advanced topic, and we'll cover that maybe in another video. And so how would you use a fair value gap? Now in these two slides, I'm just going to cover that second point. How would you use a fair value gap to enter a trade? So in this example, we have our bullish fair value gap again. So that's our 3 candle formation, 1, 2, and 3. And we have our fair value gap running across the body of that second candle. So it's between the high of that first candle and the low of that third candle. Now where we would place our limit buy order is at the low of this third candle. So that would be at the top of our fair value gap. But there's nothing stopping you from using your limit buy order anywhere inside the fair value gap that's formed across the body of the second candle. And also you can use a market order to buy in this zone as well. So that's really just a personal preference, and it may also be situational depending on what's happening in the market, what time frame you're working with, and how fast the market may be moving. And where we would place our stop is at the low of this first candle. So you can see I've just marked it on the wick here. Now what will happen sometimes in real world trading is that the wick of the second candle may actually be lower than the low of that first candle. So if that's the case, that's the low that you would use to mark your stop. Now you may also find that your bullish fair value gap forms near a meaningful swing low, and you're also able to use that as your stop as well. And again, as you'd expect with a bearish fair value gap, the setup is just pretty much the opposite. So we again have our 3 candle formation, 1, 2, and 3. We have our fair value gap formed across the body of that second candle. So it's formed between the low of that first candle and the high of the third candle. So that's our fair value gap there in the middle. Now our stop would be placed at the high of that first candle. And again, like with our bullish fair value gap, is if the wick of this second candle is higher than the high of that first candle, we would use then that as our stop. And again, if there's any relevant swing high in the region of this bearish fair value gap, you can use that as a reference point for your stop as well. In the case of a bearish fair value gap, we would set our limit sell order at the high of this third candle. But again, you can use a limit order anywhere inside the fair value gap if you want, and you can also use a market sell order anywhere in the fair value gap if you want. And again, that just comes down to personal trading preference, time frame, and also again, speed of market. So since I started talking about fair value gaps on my channel, the 2 most frequently asked questions I get is, can you use fair value gaps on other asset classes other than US index futures? And the reason for this is because ICT uses the S&P and the NASDAQ throughout his teachings, and so naturally some people think this methodology only works on those asset classes. But I can assure you, I've used them in the Australian market here, I've used them in crypto, and if you look on YouTube, you'll see traders using them across a whole number of asset classes, and certainly ICT says that he uses these in FX himself. So there's certainly no restriction on which asset classes you can use them on. They clearly work across all different asset classes. The next most commonly asked question I get is, can you use fair value gaps across different time frames across different charts? And the answer to this is yes. You'll see people using fair value gaps on charts as low as 30 seconds and a minute. I've certainly used them down to a minute myself, and you see people use them all the way up to monthly and weekly, which I do as well. And so there's no restriction on fair value gaps. They can be found and utilized across any time frame. And so from my perspective, these 2 points are actually really important, because for a model to be, robust and usable in the real world, it really needs to translate across different asset classes and different time frames. And if it doesn't do that, then that says to me that the edge in that particular methodology is probably quite weak, and it's unlikely to either work for very many people or last over a long period of time. It might be quite transient. So the fact that it works across different asset classes, it works across different time frames. As I said, you can see people all across YouTube using this methodology quite successfully, I think is really important, because that speaks to the robustness of the edge in this particular model. So that covers the learning part of the video. So let's jump into some charts now and look at some fair value gaps in some real world examples across different asset classes and across some different time frames. So the first chart we're going to look at today is the NASDAQ, and we're going to look at the NASDAQ on the monthly chart. So on the monthly chart, this is a bearish fair value gap setup, and what I've done is on each chart, it's either going to be bullish or bearish. The bullish setups will be in blue and the bearish setups will be in pink. So you can see on our monthly chart here, we have our 3 candle formation. So 1, 2, and 3, and the fair value gap resides between the low of the first candle and the high of this third candle, and it runs across the body of the second candle just here. So this is our fair value gap here. Now, as you can see, this second candle is a powerful move. You can see that this is very obvious on our chart, and price then comes back in on this candle just here and trades back up into it. So you can see that even on a monthly chart, you can use a fair value gap as a setup quite effectively, and that would have captured this downside move on the NASDAQ. Moving across to Bitcoin now. So we're looking at the Bitcoin chart on a weekly basis. Now, one of the great things about this chart is it denotes that your fair value gap can actually sit out in time for quite a long period. So remember, there's 2 reasons why we'd use a fair value gap. One is to actually enter a trade, and the other one is to mark out a zone of interest into the future. So if we look over here, we have our bullish fair value gap setup, so our 1, 2, and 3 candle formation. This was obviously forming in an uptrend, and it took price all this time to come back in and rebalance that fair value gap. But you can see the setup over here, that would have been a great entry in terms of capturing the bottom of this move here. And so again, our fair value gap is the high of this first candle. So remember, this is a bullish fair value gap. So it's the high of the first candle and the low of the third candle, and that crosses the body of that second candle. And again, you can see that second candle is a powerful up close candle. On the very same chart, we've got a bearish fair value gap. So you can see it's our 3 candle formation. So 1, 2, and 3. And the fair value gap is formed between the low of that first candle and the high of the third candle. So you can see if we project that out in time, the market's traded up into that quite a few times before then trading lower. So moving down the ladder now, if we go to a daily chart, we're looking at Ethereum. So you can see on a daily chart, this works as well, and these start to stand out. As I said, once you've seen them, you can't unsee them, and you realize they've been on your charts the entire time. So in this case, we have our bullish fair value gap. So it's a 3 candle formation. This is the first candle here, the second and the third, and our fair value gap forms between the high of the first candle and the low of the third candle. And you can see if we project that out in time, price trades back into it before bouncing away. So that's a daily chart for Ethereum. So if we move into our lower time frames now, this is a 4-hour chart on the Euro or the Euro USD. So this is a bearish fair value gap. Again, our 3 candle formation, so 1, 2, and 3, and you can really see this second candle here in the formation is really powerful. It's really pronounced, stands out quite a lot, and our fair value gap is formed between the low of that first candle and then the high of the third candle. So you'll recall from earlier in the video, I talked about how you can use fair value gaps as an entry method. Now, in this example, if we were going to use this fair value gap as an entry method, we have that not really a problem, I would say, but that variation where we have the wick of the second candle is actually higher than the wick of the first candle. So normally you would place your stop at the high of the first candle in a bearish fair value gap setup, but you can see in this particular formation, the second candle, not only is it very powerful, but it also wicks higher than the high of that first candle. So in this example, we would use the high of the second candle as our stop. So I think that's a good example for anyone who is wondering what that might look like in the wild. So if we zoom down even lower now, we're looking at a 15-minute chart, and we're looking at the Australia 200. So it's our equivalent of the S&P 500 here in Australia. So you can see we have a bullish fair value gap set up here, our 3-candle formation, 1, 2, and 3, and our bullish fair value gap is formed between the high of that first candle and the low of the third candle. And again, you can see how price trades into it before it trades away. So finally, we're going to look at the S&P on the 1-minute chart. So we've gone all the way from monthly all the way down to 1 minute, showing fair value gaps across all those different time frames and across multiple classes. So you can see we're on the ES or the S&P here, and we're on the 1-minute chart, and we have a bullish fair value gap set up. So it's our 3-candle formation, 1, 2, and 3, and our fair value gap is formed between the high of that first candle, the low of the third candle. We have our fair value gap across the body of that second candle. Now in this example, you can see price trades into it before trading higher afterwards. Now if we were using this as an entry method, similar to what we were talking about before, you can see we could either use the low of that first candle down here, or equally we could use this swing low here. And so that's something that just comes down a bit to personal preference in terms of what your risk tolerance is like. It may also be dictated a little bit by the asset class that you're using, but ultimately what you need to do is be back testing and forward testing the different variations of that to see which one works best for you and works best with your particular trading style. So that was my introduction to ICT's fair value gaps. I hope that this video helped answer some of your questions about fair value gaps and consolidated some of your learning or understanding about fair value gaps if you've covered it before. As I mentioned throughout the video, this is just really an introduction to fair value gaps. To really use fair value gaps effectively, it's critical to understand changes in market structure or market structure shifts and buy side and sell side liquidity. But these are more advanced topics and best covered in a separate video. If you enjoyed this video, it would be great if you could like it, because that'll help other people to find it. And if you enjoyed this video and you'd like to see more of them, make sure you subscribe to my channel. Thanks for watching, and I'll see you in the next video.